Hey folks, Dan Frio here with your market update. So today we're talking to you guys out there that are on the fence saying, should I buy or should I rent? Okay, so to put this in the context, we want to go over is the facts, the outlook, and then at the end of the video, I'm going to have a strategy to show you guys how you might be able to get financing and have your payments reduced quite a bit with the help of the seller. So my name is Dan Frio. I do this video every day where my goal is to inform and educate you guys everything real estate, but with an emphasis on the financing piece of the puzzle. So let's go over some of the facts that are in today's market, kind of trying to debunk some of the mainstream media's maybe twist to the markets. So the first thing you hear is, well, the market's going to crash. Okay, well, everybody's been saying that since 2020. And then it continued to 2021. Now we're halfway or almost 3/4 of the way through 2022, and we haven't seen a crash yet. But headline news that we're going to go over here next is showing that the pace of the housing market is starting to slow. Okay, we understand that piece of the puzzle. The next piece of the puzzle is mortgage rates. There's a lot of fear out there that mortgage rates are going to go to 7, 8, 9, maybe even 10%. The facts are we've basically doubled since January of this year, but since June, actually mortgage rates have gone down 0.75%. That's the facts. Okay. Now the outlooks, let me give you my outlook, is housing market is going to slow. So what we're going to see in the short term, the Federal Reserve is going to step in. They're going to keep doing what they're doing to curtail inflation and start driving down the demand for a lot of goods. And one of those goods is housing. Okay, so we know the demand is trying to get kind of stalled out by the Fed, but is it? So there's still a lot of naysayers out there that are saying this housing supply isn't the problem. And then you don't really hear anything. Okay, well, it's got to be the problem if there's what causes the price of something to basically skyrocket? Supply demand. You don't have enough demand, or you don't have enough supply, and you have way too much demand. So the market's starting to turn a little bit, but once I go over the headline news for you guys, you're going to see that the markets are starting to slow, but they're far away from crashing. Okay, so let's get over to the data just so I can put this all into context for you. I want to start out my report by going over the economic calendar that I do every day to at least get you guys getting a feel of my channel so you can be informed when is the right time to buy if you're sitting on the fence. So here's our economic calendar. I go through this every morning to explain to you guys what's coming in the news and how that should affect the housing market, especially interest rates. Well, today we had the consumer confidence come out and new home sales. I called it yesterday. I said consumer confidence has got to plummet. So the last reading was 98.4, which is really good. The forecast was it to go down to 97.2. Came in at 95. Okay, so why? Well, unless you've been living under a rock, gas prices are out the roof, food prices are crazy. Everything's way too expensive. The stock market's crashing. House prices are out of hand. My rent payments are going up. My utilities are out of the roof. I'm not confident on anything. So I knew this number was going to fall off the charts. The next piece of this puzzle that we see is new home sales. Yes, I called it. They were going to be down and down quite a bit because this says new home sales, as you can see it right in here. Well, we all know that people that are building homes, which is the new homes, they're getting skittish because most of the contracts read this. It'll take us 1, maybe 2 years to finish your house. Okay, if there's any increases in the supply or the cost of materials, we can pass that on to you. And then as soon as we get done, you got to close. But if you use our preferred lender, you can't lock in. So I'm sitting there saying, well, where's the price of this house going to be 2 years from now, maybe? Where are mortgage rates going to be 2 years from now? I don't want to do this. And so people were backing off of new constructions by the droves. And those people are moving over to now existing homes. So that's one piece of this puzzle. So I knew that new home sales were going to plummet and fall off a cliff because I see it every day. I get calls from these clients that are building houses that are pulling out saying, I just want to buy a house now and get this over with. So that's the facts. The next piece of this puzzle, let's go back to the calendar because it's a action-packed week, is this. Tomorrow, we're going to see a lot of stuff coming in. And I missed something yesterday in my report. So tomorrow we have durable goods orders coming in, pending home sales, crude oil inventories. I monitor this with a microscope. Why? Is because energy is one of the biggest pains that we see on inflation, is the pain at the pump we're seeing. But then you have the Federal Reserve coming out telling us exactly what they're going to do. And I'll give you my outlook on that in a minute. But what I missed is right here, Thursday, the GDP for Q2. Now, why is this important? Well, again, if you watch my channel on a constant basis, you know exactly what the definition of a recession is. What is a recession? It's 2 quarters in the United States of negative GDP. Well, first quarter or Q1 of 2022, we saw a negative 1.9. So now what the expectations are for Q2, I'm saying it's going to be negative. As you can see on this calendar, they're thinking it's going to be a positive. We'll wait and see on that front. But that's one of the biggest numbers that we're going to have on Thursday, because the headline news are either going to read, we avoided a recession, or are we still going into a recession, or what I think it's going to be, recession confirmed. Okay, so that's the economic news for this week that we want to go over. So now let's put all this into context. Let's go over to the headline news that we see in CNBC. Home prices slowed for the second straight month in a row, May of 2022. Okay, they slowed. Okay, you didn't see anything in here saying they crashed. There's no buyers. There's nothing of that sort. Actually, if you go down through here and see home prices in May were 19.7% higher than we were the same month a year ago. Well, if you said to me, I can have an investment that goes up 19% in a bad market, I'd be like, I'm in. Okay, I'm in. So, but what people are going to say is, well, it can't keep going. Well, why can't it keep going? Okay, you have huge demand for homes and you have limited supply at this time. Okay, this table can turn very quickly. Why? Okay, so you have not a new construction coming to market that people are bailing out of. That's number one. Second piece of this puzzle is the supply chain issues are starting to ease a little bit. Same thing with the labor forces. You're starting to get more labor into the markets that only are going to help housing. So my projection on the housing market is I would dip my toe in the sand or in the water right now and start looking for a house. Why? Well, let's go over to one other piece of this puzzle. Where are mortgage rates going? Are they going up to maybe 9, 10, 11%? Well, let's get over to that piece of the puzzle. So what I do on a daily basis, I'm just prepping you guys on what my morning videos are about, is what's going on with mortgage rates right now, okay? So this tells me basically tick by tick by tick what's going on with the price of a mortgage-backed security bond. Well, the first thing you might say is, Dan, I don't really care what's going on with the bond. I just want to know where mortgage rates are. Well, let me explain it to you. So what we see here is what's going on to the price of the bond. It is right here, okay? So the best way I can explain this to you is this number goes up. This is the price of the bond. It's not your mortgage rate or the yield on this bond, it's the price, okay? So as the price of this bond goes up, what happens is it drives down the yield. Okay, and in this case, because it's a mortgage-backed security bond, as the price goes up, the yield or your mortgage rate goes down. Okay, so we're seeing nice reactions in the market right now. The day before the Federal Reserve comes out and announces whatever they're going to announce, you have a nice little rally in the bond market, especially the mortgage-backed securities market, driving down rates. Okay, but you can also see the pattern down below. You saw everything was down until just a couple weeks ago. And this correlates a little bit on what the Federal Reserve did recently. So everybody that's out there saying, well, the Federal Reserve is going to raise rates, thus mortgage rates are going to go out the roof. Well, let's again look at this in context. The last time the Federal Reserve raised rates, actually mortgage rates started to stabilize and actually got better based on this chart. Okay, so now let's go over to see where mortgage rates are. These mortgage rates are posted daily, and I share these with you, by Mortgage News Daily. They do a scenario. They send this scenario out to mortgage lenders all over the country. They said if you had a buyer that was buying a $500,000 property with a 740 credit score with 20% of a down payment, what would the rate be? Okay, so mortgage lenders all over the country send in their information, and here's the averages. Okay, so I post this so you get an idea what the average rate is. But the biggest reason why I post this is so you can see what the changes are from the day before. So if you didn't lock in your rate, you're probably going to see this happen. Okay, but what I want to put in context right now is where rates have come from. Okay, over the past, basically we could break this down from basically October and November of 2021 to today. What's happened? Well, mortgage rates doubled. Okay, you can see that right here. But if you go back to this chart that I explained here in a minute ago, see down at the bottom down here where mortgage rates kind of were at their peak and they've come off of that. Well, how big of an adjustment is that? Well, if you go over to here, you can see it right through here. Mortgage rates hit an all-time high. Well, not an all-time high. This cycle's high just last month. It's 6.28, okay? Today's rate is 5.54. That's 75 basis points, or 0.75% lower than where we were just a month ago. So mortgage rates are starting to come back down. All right, so now let me give you my outlook on what I expect things to happen. So let me first go over what I think the Federal Reserve is going to do tomorrow. The Federal Reserve is going to step in and they're going to say we're raising rates, the federal fund rate, 75 basis points or 0.75%. They've already told us that's what they're going to do, and the markets can't afford any shocks. But the biggest piece of this puzzle, what we want to be concerned with, is the outlook. What are they going to tell us the outlook is, or the projection of what they're going to do? Because that's affecting all the markets. I think it's going to read more like this. We're starting to see inflation kind of tapering off a little bit. We see that in oil. We see that in a lot of raw materials and a lot of other things. We also are starting to see consumer demand coming down. Okay, so they're going to say this. We're going to increase the federal funds rate next meeting X, and it's going to be either 50 or 75 basis points. I don't care which one it is because it's not going to really affect the markets. If they come in at 50 basis points, it might have a little bit of a rally because people are saying, well, what the Fed's doing is working, so they don't have to be more aggressive or continue to stay as aggressive as they are. So those are what I'm looking for. I'm not expecting anybody to say, well, it should be 100%, 100 basis points or anything of that sort. So that's the short-term outlook on these things. My longer-term outlook is a recession's here. A recession's here. In a normal recession, you see rates coming down 1% to maybe in some situations 1.5%. Well, we've already noticed that rates are 75 basis points or 0.75% off their high. Is that another signal that we're in a recession? Okay, but is a recession always bad news for the housing market? No. In most recessions, housing prices do not drop. Okay, they don't drop. Okay, but the benefits of this recession is normally mortgage rates and interest rates in general start to come back down. So that's my outlook. Okay, so let me put all this into context for you right now. The market is scary. And if you're out there looking to buy your first house, you're like, I don't know what to do. Well, take all this information in, do yourself a favor and educate yourself. That's why I do the channel. Do as much research as you can. Get a realtor in your local area to help you make a decision on compare rent versus buying. Okay, but a strategy I have for you. Here's my tip of the day, or my strategy in financing. There's a program out there right now that's called a 2-1 buy down, and I'm going to do a specific video on this. It's how you can get, let's say in today's market right now, rates are 5.5%. Well, how the seller can help you get that rate down to 3.5%. And here's briefly how it works. Okay, so here's my strategy on how we can get you into a house more affordable for at least a couple years. And then it might give you time for the markets to correct, the recession to hit in, and you refinance at a lower rate, much cheaper than it would be to pay points. So the strategy is called a 2-1 buy down. Here's how it works. There's two numbers in this equation, 2 and 1. Okay, so what happens in it is this. The going rate, as we said, is 5.5%. But for the first year of this loan, your rate's going to be 2% lower than that 5.5%. So the first year, your mortgage payments are going to be based on a 3.5% interest rate. Okay, that's the 2. Now the 1. Well, in year 2, your rate's going to be 1% lower than the 5.5%. So for the next year, your rate's going to be 4.5%. Then on year 3, it'll adjust to the final rate at 5.5%. So what this is giving you is 1, an entry into the market with a much cheaper rate. 2, we know a recession's on a horizon. So why would you pay a ton of points to buy down the rate? knowing that we're in a recession, rates are probably going to come down, giving you an entry point down the road, not too far away from now, of refinancing at a lower rate with no cost at all. So that's my report for today. So my name is Dan Frio. I do the rate update every day to inform you guys everything real estate. If you'd like to find out more about me and my team, please visit us at therateupdate.com. All our information is here and we'd love to hear from you. So God bless, guys. Thank you so much for watching. If you don't forget, please give us a thumbs up, subscribe down below, hit the bell every time I post a video, you get an alert. Take care, guys, and I'll see you tomorrow. Bye-bye.